Hello everyone, it's Irfan with managing partner here of RMI LLP. I hope everyone's doing fantastic and welcome to our quarterly one-on-one session. So I'm just going to give it a few minutes and let a couple people join in here. And then as always, as we do on a quarterly basis, we'll go through some of the questions that have come in from some of our from our existing clients and followers. And then feel free as well to join in and ask any questions as we go on in the conversation as well here. So thank you guys all for joining, and I'll begin actually talking about some of the topics that we have for this quarter. So first and foremost, this quarter is really about inflation and how to deal and some strategies with dealing with inflation. So before we start with some of the questions, what I wanted to do is just talk about, I had a previous video, I don't know if you've seen it or not, but I talked a little bit about strategies for fighting inflation, right? And some of the big things to look at really are so from a business standpoint, you have to really take a look at your pricing model. Are you still maintaining the same margins that you used to? If some of your costs have gone up, have you increased your prices accordingly? Obviously, you have to monitor your competition at the same time, but this is really important. I've seen it where people have not adjusted their prices and they're struggling and their competition is going under, unfortunately, because they never did the same. So it's important to make sure you are monitoring and raising your prices to maintain the margins that you need to keep your business running. The second big impact on the inflation side is really watching your expenses. This is a point in time is where can you actually trim some of the fat, as they say. Are there extra costs that you're spending that you can reduce? Can you monitor some of your expenses a little bit closer? Can you find efficiencies to reduce staffing costs or things like that as well? And all of that, as you put it in, can end up helping make sure that you can keep a strong bottom line. Beyond that, as more questions, thanks for everybody joining again. This is Irfan with RMI LLP. I just wanted to say thank you for joining on our quarterly one-on-one session. And as people join in here, feel free to put any questions down. Our topics around inflation and fighting some of the increasing interest rate costs, but as always, we're open to answering anything. I wanted to, we do have some questions that I had mentioned, but before that, one more thing I did want to touch on here was what we call the UHT. So this year, the deadline was April 30th, 2023, when the government has implemented a new filing called the Underused Housing Tax. And there's two things that happen with this. One is there's a filing requirement and then a potential tax payment. Most people are not subject to the tax. The tax is really going after foreign-owned property that's sitting vacant. But there is a big group of people that are subject to actually having to do the filing here. And so the filing deadline was originally April 30th, but because this is the first year, that was extended till end of October. And I did want to bring this up specifically just in case if you're one of our clients or you need help in this area, for sure just reach out to make sure that everything is taken care of. And so the UHT does apply to anybody who owns a property that's a rental property that's typically in a partnership, or it might be in a corporation or treated as a trust to a corporation. So any of those scenarios, it does apply. If you own a property and it is in your personal name and you're reporting it on your personal tax return as a rental, it doesn't apply. If you own your own principal residence, it doesn't apply. But anything else, there is a good chance that it does apply. So make sure you're at least following up and inquiring to see if it does in your instance. So again, thank you all for joining. Feel free to start asking some questions. We did get some questions coming in prior, so I'm going to start by reading those and and answering those, and then feel free to start typing some as well in the conversation here, and I am happy to answer those. So the first one we got was, if a trust is created for real estate investment purposes, it's only good for 21 years and then it has to be resolved. what happens to the real estate when it has to be resolved, and what are the tax implications? So that's a great question. Many people, some of our clients would know that we've talked about, okay, can you have trusts own property? What happens with those? Maybe the trust owns a corporation that owns the property. And the simple answer is, at that point, what happens with the trust is you can actually roll the assets out of the trust and move it into a new trust or distribute it to the beneficiaries. So there's a lot of different options you do have at that time, and it really depends on the situation. But there are ways to make sure that there's no tax implications that do occur at that point in time. The most common thing that happens is it gets rolled into a new trust that gets formed at that time, which then gives you a new 21 years to operate in the same structure. Another question here for estate planning: if a parent has a will to leave their primary residence to their adult children, there are no taxes, correct? And that is correct, as long as it's their principal residence. If the same parent has a second property like a cottage, how is capital gains calculated, and what tax strategies can be used to mitigate the tax burden? So that's a great question. So multiple properties, and how do you end up treating them from a tax standpoint? So if I had 2 properties and I passed away, my principal residence passes to my kids without tax complications. The second property can go to a spouse tax-free, but if it goes to the kids, there's a problem for taxation. And what happens is it's a capital gains tax on the property. This becomes a really big issue for a lot of people, because if the estate can't pay the tax bill, the property can't transfer. So what becomes really important is to really assess and watch how the capital gain is on the property. So if you have a cottage and you have a house, you can treat one of them as a principal residence. So you pick which one it is that you want as a principal residence, and you need to assess how much capital gain you have on the other one. Once you know the capital gain, you can estimate the taxes, and the best way to offset that is usually something like a life insurance policy to make sure the estate can pay for it. And then what you can do in that scenario is the estate pays for the capital gains tax, and then the property can, the life insurance goes to your beneficiaries, which can then be used to pay off any of the capital gains tax, and the property can then transfer over. So it is really good to pay attention and watch that carefully, and do some planning in advance. That's the best advice I can say. Thank you guys all for joining. I had a few more people pop in here. So thanks for joining and watching. It's our quarterly one-on-one with RMI. Any questions you might have, happy to answer, so just feel free to put. I saw a couple of them are there, so I'll come back to those ones in a minute here. I do have a couple more that came in advance. So, is it possible to add a person to the title of a cottage rental property years after its purchase? If yes, are there tax implications? So again, like most things I say, it depends. You can add them to title. Title is very different than taxation, and the way CRA treats things, because CRA looks at what we call beneficial ownership, versus title is who's on actual title. So you can add somebody on title, and when you do add them on title, if they're being treated as an owner in the property, then that becomes a problem, because that's where the tax implications can come in. And what you have to do is, whenever you're transferring property or adding somebody and giving them an interest, it needs to be done at fair market value. So there are ways to mitigate taxes and do that. It's a more detailed discussion, of course, but the essential answer is, if you add somebody on title but you don't give them any beneficial interest in the property, you can avoid some of the tax complications that way. Because I know many people want to add people for title just for ease of transfer of property and things like that. So there are ways to make that all work for sure. And the last one that came in advance was, how can we reduce our corporate taxes? One of the questions was donations. So corporate taxes are always a interesting one, because the nice thing about our Canadian tax system is the expenses you can claim are very subjective in nature. So many of them you can actually, if you can justify to CRA that you need to incur that expense, then what happens with when you then you can write it off essentially. And any more expenses you have, then obviously less corporate tax you pay. Donations is a funny one because yes, a company can have a donation and there's no additional credit other than it becoming an expense for the business against the income that you've earned. But a lot of times donations end up becoming better on a personal standpoint from a small business perspective. So for example, if I was to go donate, I'm better off donating money from me as an individual than through my corporation many times because of the deductions that you can get. Now every case is a little bit different because it depends on your income levels and things like that, but that gives you a holistic look from that end there. So as some of the questions have come in, just gonna go and read those out. So the first one was, how do you suggest the middle class Canadians battle the inflation that's going on right now? That's a great question. I was once looking at a chart and it was tracking housing prices versus the average wage in Canada, and housing prices clearly outpaced the average wage earning. So it is, as days go by, it's becoming harder and harder to own property in the country. It's becoming harder to get ahead, as many people will say. So what I think the biggest thing is you really need to monitor your expenses in one way and have a good plan in place. But most importantly, sometimes you just need to find those additional avenues of income sources and really start to make sure you're putting money aside to save. It's difficult to do when inflation's hitting for sure, because it's like, well, my grocery bill's going up. That's money that's usually coming from the investment angle. But sometimes you have to look at other spots to cut. If you can maintain a good, consistent habit of investing, if you can maintain a good avenue to be able to do some of the planning in advance and stick to those plans, that's where you can always come out ahead. And sometimes you have to look and say, well, how can I earn some additional income? And what's happened in society is there's become a lot of vehicles to be able to do this on an easy scale. So for example, there's Turo, where we've got clients who are renting out their vehicle right online when you're not using it. Or there is avenues like, well, okay, if you've got some extra time, you can do Uber driving. And that extra sources of income, what you should be doing is keeping those aside from an investment angle. The more you can invest, the more you can throw into different investments, the quicker you can get ahead and actually outpace the inflation and outpace the expenses that you need to incur to actually get ahead. Another question that came in is, what is a minute book? What does it include? And is it required by law to keep minute books for small businesses? So great question. We get this a lot, is a company comes in and says, I need to incorporate, what do I need to do? We go through the process and they're like, well, can I go to the registries or do you do it? And my answer all the time is saying, you can go to the registries, but the biggest difference is they're not going to give you this minute book. And so what the minute book is it holds your minutes on an annual basis, but when you start, it also holds your bylaws for the corporation. It talks about the articles of the corporation. It talks about who the shareholders are, who the directors are, what some of the rules of governance are. So does a company always need it? Usually not. It's not required by law. But what happens is it's better to get it up ahead of time than you needing it in 5 years. So for example, you might say, hey, I'm going to go apply for a loan from the bank in a few years. Well, they're going to ask you for all these documents, and if you don't have that minute book, you might not be able to find them. You might not have them available. And if you need to get the minute book created in the future, it's a lot more difficult and a lot more expensive. So my recommendation is usually to just get the minute book up front. It's a small cost when you're incorporating, and it keeps everything a lot simpler for you going forward. Another question here is, when do you think the inflation rate is going to drop? That's a tricky question. The economies of scale, if we look at what's happening right now, inflation has started to drop a little bit. When we go back a year ago, when we're looking at what the government was looking at, inflation was 7 to 8% on an annual basis, and then they started to increase interest rates. When we're looking today, most of the statistics are showing 2 to 3% inflation, which is where the government wants it to be. What's nice is we had the announcement today that the government is actually keeping rates the same because they're starting to see the slowdown of the economy that they want in order to make sure that prices stay in check. So when will inflation rate drop? It's starting to get there. We don't typically get into a deflationary environment where prices go down much, but what tends to happen is we end up seeing this inflation level off and we won't see big price increases. So a lot of times what you're seeing for prices, that's the new normal, and we need to start to get used to it, and hopefully things will slow down and we're not going to see big inflationary hits going forward, at least not in the short term basis, and that will help stabilize interest rates as well, which is also a big factor for many business owners. So again, thanks for joining, everybody. It's our finale with RMI, doing our one-on-one quarterly session. If you have questions, feel free to throw them up here as we go through them. Another question here is, how does the legal structure of my business affect my taxes? Oh, that's a great question because it has a huge implication. Whether you're doing business just in Canada as an individual, or if you're doing cross-border work, your structure is perhaps one of the most important things you need to look at when getting your business going. I'll give you an example. If you're a sole proprietorship, you might not have a corporation. Well, how that affects your taxes is that all the income that you earn goes to your personal taxes. Might be a good thing, depends on what income level you're at and what income you want to show, but it could also be a bad thing because you might be paying extra taxes for no reason. So a lot of times we end up looking at your structure first and foremost. If you have a corporation, some people might have a holding corporation. I've done a few videos on these in the past, so you can feel free to check those out as well. But ultimately, the answer to your question is the structure is perhaps one of the biggest implications in terms of how much tax you pay. So whenever you do start a new business, make sure you're talking to a professional. Feel free to reach out to us, and we're happy to guide you to make sure you got the right structure for what you're doing. Next question here is, where should we invest as a beginner? What information should we be looking for before making a right investment? That's a great question. And there's two angles to this. One is you always want to gain some experience, and you want to always gain some knowledge. For those that know me personally, you'll know that I do a lot of different things, and the reason for that is I like to dip my toe into different things to get the experience from it. But that doesn't mean you go and take all your savings and you throw it into the cryptocurrency market so you can learn about it, because that's dangerous. So what I always say is, make sure you get educated. Education is the most powerful thing, I think, when it comes to investing. You understand how different things work, and when you start to find that angle that you're comfortable with, then you can start to dip your toe into it. But don't go too heavy in it. Don't take 100% of your savings and throw it into something. Start with a little bit in one space. Maybe you're going to try two or three different things, right? And talk to lots of people. I talk to many of our clients about different investment strategies and the way I work. And one of the biggest things I always talk about as well is diversify the assets that you have. You'll hear a lot of people talk about diversify a stock portfolio and you're good to go. Well, stocks is one element. Stocks tend to go up together, they come down together. Yes, each one will do different things on an individual basis, but a good example is what happened coming out of COVID. Everything dropped. Everything went up and then everything dropped again. And so people who were invested in the stock market, it didn't matter what you were invested in, you pretty much took a hit on your portfolio. And so beyond stocks, there's lending options. You can look at doing second mortgages depending on how much capital you have. There's real estate, of course, is a big one. So the most important thing is talk to people, get educated, and the more you can learn and analyze, then you get comfortable and you can make the step that you need to into the right spot for sure. Another question here was, what is the difference between partnership and corporation from a viewpoint of taxation? Great question. Big difference here. So partnership is when two people or two entities, I should say, come together to do some sort of business. So for example, me and my friend decide we're going to go open up a lawn cutting business. We both go, I start cutting one person's grass, my friend goes cuts another. We both make $20 each. We now have a partnership because that's going into a joint account. The thing that happens with partnership is that income gets calculated, the expenses come off of it, and whatever profits there, it gets split up based on the partnership share. And that's the way it works. So if I go out there and I go and cut 10 houses and my friend only cuts 3 houses, but we're in a 50-50 partnership, we're both responsible for 50% of the income on our taxes at the end of the day. So a corporation, though, is treated as a separate entity. So me and my friend can also be shareholders of a joint corporation, and the corporation follows its own rules on taxation. So in Alberta, for example, your small business tax rate is only 11% on your first 500,000 of income. So what would happen is up till 500,000 on income, the company would pay 11% taxes, and then we could get paid out individually in the form of a salary or dividends or however we deem fit. But the corporation is actually subject to its own set of taxes first, while a partnership, the income just gets split up to the partners, be it corporations or individuals, and then they're subject to their taxes in that manner. So again, thank you all for joining today. I've got some more questions here. So can we expect some interest rate relief from Bank of Canada in first quarter of 2024? Hopefully, that's the answer there. I've been looking as well. I've been following closely in terms of what a lot of the professional economists are saying, and the main prediction is that interest rates should hopefully come down a little bit in 2024, and many are predicting first quarter of 2024. Now, the one thing I'll caution people with, this is not going to be a drop of 5% by any means. When they're talking interest rate drops, we're talking maybe a quarter point, half a point, and then we'll have to see how those have an impact on the economy. So I think there will be some drops coming, but I don't anticipate them personally being very big in nature. We're seeing a small slowdown of the economy right now, but there's still, like I said, right now the numbers are showing 2 to 3% inflation, which is right in line with the target. They're not in a deflationary environment where we'll see big drops of interest rates. So I think it's coming, but I think they'll be very minimal in nature. More questions coming in here, so thank you guys for asking questions. We're focused around interest rates and inflation, but happy to answer anything as always. So is mutual funds managed by banks a good option until we learn to manage finances on our own? Well, that's a tricky one. You have to be very careful. I find banks have they have access to investment vehicles, but it's mostly important to understand what you're investing in. What tends to happen a lot is sometimes banks will put in your money into mutual funds where you're locked in for a period, or they have really high management expenses, so they're not actually making you a return that is suggesting. I think there is a lot of different avenues to invest. I think it's really important that you pay very close attention and learn about it, and then make a good decision. Mutual funds used to be very popular back in the day. What I'm finding is more popular these days for that set it and forget it example is some EFT funds. They're different types, like it's like a stock ticker, but they have their own EFT symbols, and they're a conglomerate of different stock investments as well, and you can find a few good ones with a little bit of research, and I think those tend to be outperforming what tends to be seen in mutual funds and different things like that. So I would say mutual funds, they can be okay in a small scale, but you want to be very careful with them as well, because they sometimes come with hidden costs or different things like that. As a business owner, what's the optimal approach becoming an employee or receiving compensation through dividends? This has to be one of the most talked about topics, I think, for business owners, especially small business owners. The difference that I tell most people to consider is this. The main thing that it comes down to is CPP. As an employee of your business, you need to contribute into CPP. If you're receiving dividends, you're not contributing into CPP. So that can save up to about $7,000 a year per person. But you need to understand, if you're doing dividends and you're not contributing, when you retire, you're also not going to get that CPP money. So that's the biggest factor, but there are some others. If you're an employee, you can claim childcare expenses. If you're on dividends, it treats your employment income as zero and you don't get to claim childcare expenses. So that might be a factor. Those that like to put RSP money aside, if you're an employee, it will increase your limits. Dividends do not. So there are those different factors to always look at. Always best to talk to your accountant to make that decision. And it is really a personal choice. I always go through this same conversation with a lot of our clients and let them decide which route makes the most sense, obviously with some guidance based on their situation. Great questions today, so please keep sending them in here. Considering the cost of compliance, when should a small business consider to incorporate? Great question. Another very common topic that I get asked, and the answer I typically give is this, is one, you want to look at liability. Are you entering a business where the liability risk is high? If the answer is yes, then you probably want to start looking at incorporating right away, first and foremost, because you don't want that liability attached to your personal name. The second one is, are you doing this as an individual, or do you have partners in the business? Then you also, with partners, you might want to look at doing the corporate structuring ahead of time, get ahead of it. It keeps things more simple, cleaner that way versus having a partnership on a small business or sole proprietor side. And then the third big one, if all things being equal, the question comes in is, can you save money inside your corporate structure? If you can save some money inside your corporate structure, there are potential tax savings up front that you can then use to invest. And so if you are able to, then there is a benefit to incorporating as well. That number loosely I always give is about $15,000-$20,000 a year. And if you feel like, yeah, I can save some money, I'm going to take some lower taxes today, then you've got that benefit. If you're telling me I'm in a low risk business, I don't have any partners, I'm not going to save any money, I need it all for my day-to-day living, then at the end of the day, maybe it doesn't make sense to incorporate. So that's the stuff that I asked to really look at. What are the tax benefits of taking money as a shareholder or through dividends? So similar to my previous answer there, if you're getting paid in the form of dividends, the big savings that you see is CPP. So at the end of the day, the CRA has tried to make the tax rate very similar for if you're taking a wage or if you are getting paid as dividends. So taxes, I always kind of say they're very similar in nature, so they're not worth necessarily debating about because they tend to go up and down but stay very close. But as in the form of dividends, the biggest savings you'd see is not having to pay the CPP payments. And so that, like I said, can be about $7,000 a year. Could be good or bad, as I previously mentioned, that you always want to look at. How can I avoid red flags or mishaps with my returns or audits? So best thing here is working with a professional, I think. They know what to keep an eye out on, what to look for. And the other big thing is make sure you got documentation for everything. So they always say keep your receipts, keep your statements, and make sure you're organized. The more organized you are, the easier any audits will happen. A lot of times if you're a business, it's not a matter of if, it's a matter of when you're going to get audited. And when they do, you want to make sure you can hand everything over, keep it clean, and make sure there's no questions. So the more organized you are, working with a professional, all those things will help you for sure. And I got a couple more minutes here, so I'm going to take this last question. Any business ideas as a beginner in the current market? Would like to know more about product sector. Business ideas, there's plenty out there. The funnest thing that I like to do though, personally, is whenever I go on a trip, I look around and I see what different businesses are there. If I go to the States, there's many different ideas there. Can any of those work up here in Canada? What are people doing in other cities that you can bring over? Products, it's about getting innovative. What can you do there? So there's lots of different business ideas, but if you're just starting out, the easiest is honestly to start as in a service-based business. Less cost, less startup, unless you have investment capital behind you, it's very difficult to go into a product-based business that requires a lot of heavy upfront capital, or a retail store or different things like that. But service-based businesses are very low cost. It's more a time investment that you can do and then build from there. So that's one of the things to keep in mind as well. And the last question here, should I invest in stocks through company or as an individual? It's a tricky question, but as most of my answers, the answer is it depends. Depends on how the company or how the income's earned. What's the focus? Are you focused on growth stocks? Are you focused on dividend producing stocks? When you do it through a company, there are different tax rules because it is considered passive income when you're earning them. So you do pay additional taxes up front, but then you get a dividend refund when you give that money back out. But if, for example, you're earning through an active business, you're earning income and you have a holding company, it can give you more capital to invest through the company and through the corporate structure rather than taking money out personally and paying the higher taxes first. So a lot of times in that scenario, you might invest through your company. But a lot of times if you're earning income as an individual, then you might invest as an individual. Or if you're focused on different, if you're for example, getting a private company where you might be able to use your capital gains exemption, then again, individual side would work better. So as most scenarios, it depends, but feel free to always reach out regarding your scenario, and we're happy to look at that further. So thank you everyone for joining me today. It's Finale with RMI LLP. As always, we're always happy to answer any questions you might have, so feel free to reach out anytime, and either myself or one of our colleagues can for sure help you out there. Thank you, and I hope you all have a fantastic week.